Hey everybody, and welcome to another video DD for the technical analysis of GameStop from the week of 8/2 through 8/6. We're going to take a look at some of our uh, forward-looking technical indicators, get into some of the things going on with the stock, and touch on some things occurring in the market. The first thing I want to go over is generally when I do these, I kind of only go over the bullish sentiment. This time, I'm going to take a step back from that. I'd been doing that in order to kind of discourage people from day trading the stock. If they don't know the low, the entries are worse, Um, honestly, at this point, I really don't think it's my responsibility or duty to worry about that. And so this time, I'm going to kind of go over all the places the stock can go, because not only do I think apes knowing when the dips will be is a huge opportunity for those trying to pick up maybe that one extra share, but also I want to have an honest outlook going forward on the stock, and I want you guys to be able to see where the potential movements are and not just the moments of bullish outbreak. And so we're going to kind of cover both this time, which is a little unusual, but I promise I'll try to make it easy. So the first thing we're going to look at is our technical indicators for this week. We're still within an ascending triangle. This will continue ad infinitum until something else takes its place. This will just keep moving further and further out as time goes on. Our next test of 300 could change some things on this, but in the meantime, this is the primary pattern that we'll be observing. It's supported by this ascending channel here, and here is our close Friday. I want to point out that we are now in the peak position of a double bottom formation and this is the daily chart. I have tracked the bullish and bearish possible price actions. A double bottom is a pretty good indicator of forward-looking price action. They're about 78.5% correct for upwards breakout, but that still leaves an 11.45% chance for a bearish downtrend and some chance at a neutral one. Right now we've just bounced off the 162.50 resistance. I expect that we will continue to bounce whether we trend to the downside or not, at least to a test of 180 sometime in the next couple of days, especially as the market makers cover some of their gamma exposure from last week's contracts. Let's take a look at a slightly more zoomed in version of this. So as we can see here, we have a possible bounce here off the center of this double bottom. This has about a 78.55% chance of a breakout to the upside. We have a decent chance at running neutral for the week, and then about 11.45% chance of a bearish breakdown. If we do break down, I expect to bounce off of the long-term trend line here around $150. And if we break to the upside, I expect support to come in here on the ascending channel there as our price moves forward. Here is that confirmed support trend. This has several points of support. This is a low possible support here. It only has one other point of reference. So it may be weak, but it's really all we have to work on right now. Is I don't expect too much price movement below 160. So this range probably won't happen, but there is a chance that it could. And so I'm kind of just showing you guys what's going on there. And now we're going to take a look at some of our other technical indicators to help support this. So we're going to look at MACD here. Something to note on the MACD is back in April, we had a false breakout due to the at the money share offering, and it threw a false signal. This happens on MACD. It's not too common, but it can happen. And we've just had another false signal here. This one lasted about half the amount of time. But I expect that we will repeat a similar pattern to what we repeated back here before our May-June run-up. So we may see a couple down days before MACD reverses and moves to the upside. Next up, we have our stochastic RSI, which is a momentum indicator. Our volume's been super, super low, and so I've smoothed this out to 14, 14, 21, 21, which is, this is Stoch, this is RSI, and this is K and D values. And what that does is allows us to encompass more volume into the indicator. Anyway, we had a KD crossover here, which is a bullish divergence. As you can see, we've had a bit of a downtrend over the last week on the K signal, but D is still coming up strong. We may see something similar to what we saw back here in May-June, where we kind of downtrend a little bit and then come up and complete the pattern into overbought. But yeah, we're still oversold, still looking for a pretty bullish uptrend from that. Next up, daily RSI, which is our relative strength index. I always mark the 6 and the 14 on RSI. 6 is just a little faster moving. This is on the 1 day again. And here you can see that the 6 has dipped below into oversold, which generally indicates that you will see an uptrend bringing us into overbought. You can see the RSI 14 down around 35. The midpoint's usually considered to be about 40. So anything below that, pretty bullish. I would expect that sometime soon we'll see a move on this, bringing us back into overbought territory. Next up, I kind of wanted to talk about this thing that's been going on with the stock. I've discussed it a lot on the stream intermittently, but maybe not so much in these videos or in the DD. And so I'm just going to try to cover this real quick. Essentially, what's happening right now in the stock is the short hedge funds are being squeezed vis-a-vis out of the money call options. So as they bring the price down within the money puts and delta hedging, they're using the market makers to short the stock for them, as a lot of the new regulations prevent them from shorting the stock with naked shares the way they were before. And while shorts are dropping the price, behind them, the long hedge funds or long investors that are long on GameStop are buying out of the money call options. So as the price decreases, so does the price of out of the money call options. The long hedge funds are snapping those up behind the falling price. And then what's going to happen is eventually the shorts will reach a point where they can no longer suppress the price, or retail and institutional buying pressure increases at the floor of the stock, which will then push the price up into this waiting gamma ramp. Here's a good example of that. So as the shorts bring the price down, you can see we have retail here on the bottom at the low end, holding the floor of the stock. And we have the gamma ramp here built up around it. The shorts have to kind of sit in this range in order to stay safe from an explosive breakout to the upside. And since our weighted VWAP is at 180 currently, if you weight it back to February, that means about 90% of the shares owned by retail and institutions are have a cost basis somewhere between 162 and 198. So a dip below 162 means that all of those investors have an opportunity to average down on their position, hence the low end buying pressure pushing up. And so the short hedge funds are kind of in a pretty precarious position here as they try to dodge the floor and the gamma ramp. And this is what constitutes the squeezing aspect of a short squeeze. And this is how you get hedge fund tears. Lastly, I want to go over the market. The Biden administration has ruled out the option to extend the eviction moratorium vis-a-vis executive order. And so the onus of that is going to fall onto Congress, who is taking a break for their their district work furlough or whatever that is. Essentially, they have to go back to their districts and work in their districts. It comes at a really inopportune time, but I'd imagine something will be done about it going forward, and we won't really see an effect of this on the market or the economy for about 30 to 180 days, depending on the state and how long their court systems take to handle evictions. I know FHA mortgage holders have an extension already, so we'll see how that goes going forward. But the sentiment of it may be enough to shake the market. And so on Friday, the S&P 500 tracking ETF, the SPY that we follow, had a bit of a bearish divergence. As you can see here, the SPY doesn't trade flat. And right here is where we saw the bearish divergence. So going into Monday, I'm going to be looking at the correction zone that we've drawn here for an indicator that we're moving into some sort of correction on the S&P 500. If we fall below that into correction zone 1, 2, 3, and then finally into a sell-off or market crash, I will be paying pretty close attention to that throughout the week on the stream. But remember, as the price action declines through these zones, it can accelerate. This can happen very, very fast. With the inflation fears and everything else going on, I really do expect that something like this may occur. But the Fed has shown a propensity for propping up the market for the last few months, I think, and they may continue to do that moving forward. Remember, it's always bullish until it's not. And then lastly, I'm going to show you guys the Schiller PE ratio. It's down about 14 basis points this week. But still significantly higher than, Black Tuesday, Black Monday crashes, still approaching those all-time highs seen during the dot-com bubble. This is still a really strong indicator that we're heading into a significant shift in economic sentiment and possibly, a bear market. And that's about it for this week. If you guys have any questions, feel free to leave them down in the comments below. As always, you can join me for our daily stream Monday through Friday, 9 a.m. to 4 p.m. Eastern Daylight Time. And if you guys could, please drop a like, subscribe if you want to see more of my content. And if you guys want to help support the channel, you can do that through our Ko-fi link down below in the description. Thank you guys all so much, and you have a wonderful night.